Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. And today, I'm going to be talking about trading short verticals over a shorter time frame. We're going to be discussing 5 key considerations when trading weekly credit spreads. It's going to be an interesting discussion. The markets have been very interesting and choppy for the shorter term trader. That might be just what they're looking for, but there are some things that a would-be credit spread trader might want to keep in mind as they're trading over those shorter time frames. Really looking forward to the discussion. Before we can get into the particulars, though, let me first of all say hello to everybody who's already chatting in. Great to see a bunch of familiar names here. I'm kind of the interloper here. I'm filling in for Brett. He's not feeling great today, so he'll be back again next week. But hello there, Kevin and Wiley, Richard, Alfie, Sharon, Paul, Cecil, everybody else. Thanks for joining us week after week in these presentations. We definitely appreciate your contributions to the discussions here. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. That's a great way to watch these presentations. But if you'd like to be here during the live stream as an audience member, well, this is a Thursday webcast series, and we kick it off promptly at 2 Eastern time. Now, I also want to let everybody know that my very good friend Scott Thompson is hanging out in the chats with us today. Scott's going to be keeping an eye on any questions that come in, and if I can't get to those, he's going to help pick up my slack. But Scott and I have now been working together for a couple of decades. He brings a ton of experience to this discussion. Thanks for being there, Scott. I'd also like to issue an invitation to everybody listening to follow me on social media. It's the best place to connect with me in between the live streams. So you can find me on X. My handle there is @CameronMayCS. Give me a follow there. Or you can also now find and follow me on LinkedIn. Just go to linkedin.com/in and then /CameronMayCS will take you to my profile. You can give me a follow there. But let's get into this discussion of 5 key considerations when trading weekly credit spreads. Of course, as we do, we need to bear in mind the risk associated with any approach to trading or investing. These disclosures are important. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for what we're going to be talking about today. I want to take a quick peek, first of all, at the markets. And specifically, I want to look at the market conditions over the last 4 to 6 months and why for some, that may be inclining them to more of a short-term approach to things. Now, it's obviously not going to be the way that every trader approaches things, but I do want to frame this discussion within the context of someone who's maybe trying to be in and out of their credit spreads very quickly. And as we plan and place an example trade with that assumption, I want to talk through 5 potentially key considerations for that would-be short-term credit spread trader. So before we're done today, we're going to wind up actually planning and placing an example trade on Thinkorswim Paper Money Desktop, that trading software platform. So let's go right to Thinkorswim and let's have a look at the S&P 500. You know, in the latter months of the summer, the S&P was still having a nice run to the upside. But if you have felt like stocks have struggled to really make significant advances, and it seems like it's been quite some time since we've really made progress, you're very likely not alone, because if we look at where we are right at this moment as we're having this discussion, and we roll this back, this is really about the same position we were in as we were looking forward to the Halloween holiday. Yeah, we're right about the same levels as we were back in the 3rd or the 4th week of October. So during that time frame, stocks have been up, they've been down, they've been up, they've been down. For a short-term trader, that might be actually just fine. For someone who's looking a little bit intermediate to longer term, this has potentially been a period of some frustration. So what I'm going to do today is let's do a relatively quick trade. Right, we're going to be trading weekly contracts, and we're going to do that. Obviously, this webcast series called Short Verticals, we're going to be doing a credit spread. Now, a quick decision needs to be made. John says, is this going to repeat? I don't know, John. Time will tell. but let's just go forward with the assumption that we're just going to get more of the same into the foreseeable future, right? I always like that phrase, the foreseeable future. The future with markets is largely not foreseeable, kind of the point, right? But let's make a quick decision. Let's say that we're going to get into a trade that we're planned to be out of within 7 calendar days. That's going to be the extent of our vertical spread today. Should we do a bullish or a bearish trade? Well, one thing that our short-term trader might note over the last, I don't know, 4, 5, 6 months is that if stocks had been going down for the most part for the trailing week, there seems to have been a higher probability that they're going to go up for the next week and vice versa. So what some technicians might do, and this is not a guarantee of what is to come for stocks, they may look in the immediate rearview mirror and see what the prevailing direction has been, and actually go counter to that when we're getting this sort of choppiness in the markets. So in this case, stock prices have generally been coming down, now stretching back about a week and a half. So could we be at or near another short-term cyclical low? Let's say that's our trader's thesis. Now, at the same time, we're also kind of right at an inflection point for stock prices, potentially right near an area of support. So let's just say that our trader here is looking forward to the next week, and they're going to be doing a bullish trade on the assumption maybe we're at a short-term cyclical low, finding some support, and potentially, in their view, more likely to rise than to fall as we go into the next week. So let's do that short-term weekly trade. All right, so we're going to be trading weekly contracts. I suppose one thing, I'm going to add this as a 6th consideration because I wasn't planning to talk about it, is that not every optionable stock actually offers weekly contracts. So it can depend on where we are in the month. Maybe there's a traditional third Friday expiration that's coming up within a week that might offer an expiration within the intended time frame, but otherwise we might be looking at a limited group of stocks. However, I'm going to just call this now the official key consideration number 1. When we're trading short-term contracts, the trader might want to have a strong emphasis on being nimble, being able to get into and out of contracts as efficiently, as quickly as possible. And options, unfortunately, especially as we get closer to expiration, what's been your experience? Those of you who are more experienced with options trading, does it become easier or harder to get into and out of contracts efficiently and quickly? It actually tends to get harder. The spreads tend to widen. The liquidity tends to dry up a little bit. So key consideration number 1 is just the overall liquidity of the contracts. When trading these short-term options, for some traders, a very high priority is to make sure that liquidity is as strong as possible. So one thing, yeah, and Cecil says it gets harder. Paul says the last week is harder to trade these things. Yep. So what our trader might do with that as a point of emphasis is to just stay with among the most liquid stocks. Highly liquid stocks tend to have more liquid options than, let's say, options on other securities. And so what I've done here is I've just loaded up the S&P 500. This is just a public watch list published by Thinkorswim. So if we don't have it, we can just click on this, go to the public watch list, go to the S&P 500. And then the second thing I've done is I've organized these according to their market capitalization. And right at the top with the highest capitalization stocks first, we are now looking at literally some of the most liquid companies in the world. NVIDIA, largest market capitalization company in the world at the moment, followed by Apple and Alphabet and Microsoft and so on. So if liquidity is a point of emphasis, this is a quick way to improve that liquidity to the extent possible for the trader. It's still not a guarantee that we can efficiently get in and get out, but we're just trying to do our best here, right? Okay, so how about we just use, let's click on NVIDIA and see what's going on there. And as I look over the last 6 months, here's something that's interesting. NVIDIA's trading has almost entirely been above the 170 level. Let's structure a trade based on that, but move on to key consideration number 2 out of our 5, which is when we're getting into a contract, and here's the one, maybe to set this all up. Let's go to the trade tab and let's look at the contracts that are available that expire within 7 days. John says, do liquid stocks typically have higher volatility as well? Actually, John, no, not necessarily. The most liquid stocks tend to be among the largest, and the largest companies actually tend to have lower on average volatility than others. Now, that can definitely vary from one company to the next. That's a broad general statement. But no, generally the volatility can be a little bit lower. But let's look at the expirations that are available. And I would forgive you if you are looking at this saying, hey, there's something weird going on here, Cameron. You're teaching this webcast on a Thursday. Yes, I expect to have some weeklies that expire in 1 day. What the heck is this expiring in 4 days or in 6 days? 4 days from now is Monday. 6 days from now is Wednesday. Yeah, just what was it, last Monday, I think? Well, it was introduced the 23rd of January. I can't remember exactly when. But just within the last week or two, there was a new type of option introduced. And it's weekly contracts that expire on days other than Friday. And this is for individual equities. A few, not very many. It's actually the Mag 7 and then 2 others. But there are now Monday expirations for NVIDIA. There are Wednesday expirations for NVIDIA. And there are the Friday expirations. So how about, I'm going to be looking at, let's trade this Wednesday one. That one's actually expiring within 7 days. It's within that narrow technical window that we saw on our stock chart, where the trader is just looking here at maybe the next week. So let's use this one, all right? Now, as we look at this very short-term time frame, key consideration number 2 is going to be a battle between 2 competing forces in the ultimate success or failure of this trade, and those forces are time and price. So theta, when we're trading right up close to expiration, we're selling for a credit, and we're looking for this to hopefully expire out of the money, and if we're structuring the trade so that it's out of the money on day 1, is time working for or against that trader? So theta in this battle. So let's just say key consideration number 1 is liquidity. Let's get the other I in there. Key consideration number 2 is theta versus, I'm going to phrase it this way, gamma. Time versus price. But yeah, theta or time decay is actually working in the favor of the trader if they're putting on an out-of-the-money trade, hoping that it expires worthless. There's only 6 calendar days for this trade to actually slip in the money and work against the trader. So time is working more in the favor of the trader than, let's say, a longer-term contract. However, on the other side of this battle, time, the champion for us, gamma risk is working against the trader here, or it can. I don't know if you're familiar with gamma risk, but it's a way to measure how the impact of a move in price on the ultimate success or failure of the trade. So gamma, if you're not familiar with gamma, most of us know that delta can tell us a couple of things. It can tell us the relative likelihood that a contract expires in the money, but it also can tell us how much a contract might increase or decrease in value on a $1 move on the stock. And then the next dollar move is measured by gamma, or pardon me, by delta plus gamma. It tells us how much that price impact is growing. So it's sometimes expressed as gamma risk when we get right up close to expiration. What's happening is, as time is hopefully working in our favor, what can also happen is if price moves in the wrong direction, there's hardly any time left for the stock to course correct, for price to start working for us. And then we sometimes call that gamma risk. So that just means one thing that we have to accept, it's just part of the business of trading weekly contracts, is that a strong price move in the wrong direction may put this trade into almost irreversible loss territory. All right? So just be aware of that. We have time working more in the favor of the trader, but gamma risk is more prominent as we get closer to expiration. Now, consideration number 3 is definitely related to this, and that is the trader may want to keep an even keener eye on what we call event risk. What is event risk? Well, certain events can carry risk. For example, if in that week between the time we initiate the trade and we get to expiration, hopefully get to expiration in a profitable scenario, any event like an earnings announcement or an economic event that the underlying company has particular sensitivity to can spiral this trade into loss territory. So we call that event risk. How might we mitigate event risk? I'll tell you, time versus price, it just is a fact that exists, that's sort of the tug of war here. Anyway, but event risk is something that we can keep an eye out for. Let's go to our charts. One thing that the trader might do is they're planning a trade. Let's see, this would be for the 11th of February. That was 6 days out. Let's try and align. Look at this. My impulse was to go further away from the current price into our right expansion range, but really, our contracts we're about to trade are set to expire right here on the 11th. That's not very far out, right? But what we might want to do is look to see, is there any of these red and blue icons appearing? What is a red and blue icon? This is an earnings announcement. Now, I checked NVIDIA before launching this webcast, and it's not scheduled to announce its earnings until February 25th. That's a solid 2 weeks after the end of the planned time frame. But an earnings announcement, if it doesn't go well, can cause a stock, even if it's sitting at a support area, even if we think it's likely to go up, it can cause it to just go right on down. It's also possible there could be a positive earnings announcement. It's just not good enough for the shareholders. It could go down. So let's see, Alfie says, when analyzing risk, how many studies are enough or too much? That is up to the individual trader. It's a good observation. It's a good question. You know that I do a lot with technical analysis, and I'm tempted to go deeply into that discussion, but I want to keep the focus on the options portion of the discussion here rather than on learning charting in greater detail. If you're interested in that kind of stuff, you may want to check out my webcast series. It's called Advanced Charting Techniques. But yeah, it really does come down to the individual trader. For example, some traders may not use any technical study at all. It might just be an observation of price movement. They might just look at this and say, well, we've stayed above 170. I don't need anything to tell me that if the next week goes anything like the last 6 months, I have a pretty decent probability of staying above 170. Now, that's definitely not a guarantee that that's exactly what's going to happen, but it didn't require any additional studies. But if it makes them feel better, maybe they can throw on a moving average, throw on an oscillator, and see if that gives them, in their view, some deeper insight into previous price action and where it may be headed from here. But in any case, we can check to mitigate our event risk, look for upcoming earnings announcements. We might also check the economic calendar. Are there any big scheduled economic events? Obviously, news can drop out of the sky, but there are some events that can be anticipated. At least the timing of the events can be anticipated, not necessarily the outcome. We can anticipate the timing of an earnings announcement. We can anticipate the timing of an economic news announcement. But if you don't know where to check for economic news, you can pop up here to the Market Watch and check the calendar. So here we are on the calendar. I have this set to a weekly view. No really big news today. Tomorrow's a little bit more active. Consumer sentiment, possibly the strongest, the announcement that tends to have the greatest impact. Even that can historically, typically fairly limited. What about next week, though? What big news is coming out next week that might move the markets? There are a few things. There's been particular market sensitivity, for example, to jobless reports. Just today, some of the tech stocks, or pardon me, just today we had kind of a reaction on yields to jobless claims. Now that's coming out again next week, but it typically has kind of a muted impact. GDP, potentially larger impact. Also on Friday, we have CPI being reported. Now before that, Monday, Tuesday, Wednesday, not a lot of, well, there is PPI. Actually, that is something I might call our attention to. That could move the markets, and that is the day of expiration for our contracts here. So this is where a trader can come and check and just see, are they comfortable with what's on the calendar? Now, obviously, market moving events can stretch beyond the calendar. You never know when something new is going to come from the White House. We never know when something new is going to come from, well, just could be anywhere, right? But in any case, there we go. Event risk is a third consideration. Number 4 is strike selection. Can potentially matter even more because there's so little time to course correct if things go wrong. So for some traders, using charts may help them feel a little bit better about their strike selection. As an example, if our trader is convinced that the stock price is likely to stay above 170, at least through the 11th of February, to allow these contracts to get to expiration, hopefully still out of the money, maybe they set up their credit spread at or below that support level. And this is just an example support level. Maybe somebody has a different view of the charts. Another thing they might do for some traders, in structuring their trade, they'll look at something like the market maker move, this plus or minus 932. How many of you have ever looked over here and wondered, what is this? Plus or minus 932. I don't know what that means. Maybe I'll ask Cameron someday, but I forget. What this is it's a projected range of how much the stock may rise or fall based on the prices that options are trading for the expiration that we're viewing here. So for February 11th, an extrapolation of options activity and pricing might project that the stock could move up or down maybe as much as $9.25. Now that's an estimated range. It can certainly, our stock could go higher or lower than that, but this might provide some guidance to some traders. For example, if they want to give themselves wiggle room where they're structuring the trade to have a higher probability of just expiring out of the money, maybe they structure a vertical spread that's $9.25 or more below the current price. Vic says market maker move, just a projection. Exactly right. Yeah, it is a projection only, and sometimes projections are wrong, right? And just because it says plus or minus 925, maybe it moves a whole lot less than that. Maybe the stock just doesn't move much at all. This is just sort of a projected range in expected price. It's not a huge logical step to project that range based on options trading, because if options traders don't expect much from stock, maybe they're not expecting much movement at all, they will tend to pay less for calls, they'll tend to pay less for puts. There's just less demand because there's not expecting much movement. If there's more demand, if prices are stretching, that might project a larger expected range in price. Options traders don't have a perfect insight into the future, though, so this comes with its limitations. But for some, they may use that to assist in strike selection. But in this case, what I'm going to do is let's just use, how about our support level of 170? Now with the credit spread, if we were being bearish, we'd do a bear call spread. Let's set up a bull put spread with the short strike at least at 170, potentially below. Now finally, so let's do that. Let's go ahead and let's plan our trade. So go to our trade tab. I wonder what we can get. 11th of February, if we go to the 170 put, Looks like that's trading between 266 and 268. And what if we went $2.50? Let's go to the first strike here below, and we'll buy maybe the 167.5. So that will be our example credit spread here. Here's a quick way to structure that trade. Well, first of all, how about I'm going to spell it out here in our scratch pad. So our example trade, let me give myself one more space because I got to fit in number 5 up there. There we go. Our example trade is going to be a bull put spread. And for this one, we're going to sell the 11th of February, 170 put. Let's say we were able to get that, let's say it's 280 right now. Sell that for 280. And at the same time, we're going to buy the 11th of February, 167.5. That looks like it's, let's say it's around 210. Obviously, price is going to change. Markets are open. You'll see those fluctuating. John says, I thought the delta was supposed to predict if it was going to finish in the money. John, that's another way that we might do it, right? As I mentioned, I hinted at it just a little bit earlier. Some traders might use delta as a general guide. Yep, delta, when we see a delta of 35 as an example, that means the contracts might gain 35 cents or lose 35 cents if the stock goes up or down $1. But also, it means there's about a 35% chance that the 170 strike ends up in the money at expiration. Now, just to illustrate gamma risk, though, just for the heck of it, let's switch Vega here. Let's switch this over to gamma. If the stock were to move $1, the next dollar move might be a well, it can change the leverage of the contract, change the price impact by, or change that up to about 38 cents. Anyway, let's see what the realities of our vertical spread might be if we go ahead with this. So the 167.5, 170, it looks like it might leave us with about a 70-cent credit on a $2.50 wide spread. That's going to leave about $1.80 of risk for the trade. So about $1.80 risk, about a 70-cent reward, but we just need to stay above 170 by expiration for this trade to work out optimally. Let's let that be our trade. And I want to talk about key consideration number 5. Okay, but our net credit, our assumed net credit at this point, because we haven't submitted the order, net credit or max gain on this trade, also known as our theoretical maximum gain, would be about 70 cents. Correct that. If we collect 280 and then spend 210, that leaves us with a 70-cent credit. The theoretical max loss of our trade here is $1.80. How do we come up with that? Well, we're getting ourselves into 2 contracts here. One of those allows someone to sell us shares of stock of NVIDIA for 170 bucks. So if we get stuck with those shares at 170, the other contract allows us, in a worst case scenario, to sell those shares for 167.5. That would be a $2.50 loss, but we did get a 70-cent credit to set this deal up. That leaves us with $1.80 of risk potential. So what do you notice here? Smaller reward than risk. Yep. So here's gonna be key consideration number 5. Having a plan for both profits and losses. All right. Let's see. Question just came in. Ravindra says, another question looking at SPX. Okay. Looking at SPX, let's say we put quite a few bullish put spreads, but suddenly this week we had a big crash. How should we divide portfolio, both bullish and bearish trading? Ravindra, my apologies. That would just be too much for me to try to tackle in this webcast without getting way off track and then try to pull it back into this discussion. So it's a good question. It's probably too big for me to try to handle. It would be essentially too large of a departure from what I'm trying to cover here. In any case, our trader here, trading just a week before expiration, knows that if this goes well, we can make up to theoretical maximum of 70 cents. If it goes poorly, we might lose as much as $1.80. There is much more at risk than there is to gain. So what they may be doing in their planning stage for managing profits or losses is let's say we're trying to optimize, try to get as much of the reward as the trader can while minimizing the risk exposure. So there are a number of ways that we might do that. But one thing that some traders will do is they'll actually have a plan to take profits when they're available or to cut losses fairly early if the stock starts to misbehave. So here's just an example. Let's say that recognizing that the reward potential of this trade is already relatively limited compared to the risk, what if our trader wants to take profits, if they can, at any time in the next 6 days before expiration and still retain 80% of that reward potential, or realize 80% of that reward potential? How might they do that? Well, if their net credit is 70 cents, that's how much they're getting paid to get into the trade. How much can they spend to get back out and still keep 80% of the 70 cents? Well, if I want to keep 80%, that means we can only spend 20% of what we were paid. In other words, we can only spend 14 cents to close this trade out. Let me reverse this logic. If we get a credit of 70 cents, and then we spend 14 cents on the back end of the trade to get out of it, that would leave us with a realized gain of 56 cents, which is 80% of our 70%. I know that's quite a bit of math. Nice thing about these webcasts is they are recorded, so you can go back and revisit this logic. But I like to state the logic, get it on the recording, and then you can go back and listen to it at your own pace. So here's what our trader might do. Let's put in an order to close out at a 14 cent limit. Okay. Now that's to plan for potential profits. What if this trade starts to misbehave? What we're hoping for here is that we collect 70 cents and that starts to work its way down to zero, so we can get out relatively less expensively. On the other hand, if it starts to become more and more expensive to get out of this trade, in other words, the stock is misbehaving, how can we stem the bleeding at something less than $1.80? Let's say that our trader, instead of waiting around and maybe exposing themselves to losing the full $1.80, maybe they want to chop that in half. Cut off our losses at a 50% stop. Or what's 50% of $1.80? That's 90 cents. But we're not going to put in a stop at 90 cents because we received a credit of 70 cents. We're going to put in a stop 90 cents above what we received. So a 50% stop would be actually, just quick math, would be $1.60. All right. So again, to revisit that, if we start our trade off by collecting a credit of 70 cents, and then it starts to misbehave and it's growing in value, rather than shrinking, it's growing. And we get to the point where it's going to cost us $1.60 to get out of this trade. Let's say that we do it. Let's say that we stop out. Well, that's 90 cents more than what we originally received as a credit. Or in other words, it's half of how much we could have lost ultimately. There we go. So that might be just an example plan. That's planning for both sides of the trade. Not everybody's going to go for 80% of the maximum gain. Not everybody's going to go for 50% of the maximum loss. It could certainly vary from one trader to the next if they use this approach at all. But let's go put this trade in now. Now, the first thing I need to do is let's just double check and see what this is trading for, because I've been explaining this and prices have been changing. So I'm going to change my spread from single. Let's change that to vertical. And that actually pairs the two strikes up with each other. It looks like we might actually be able to get a little bit more of a credit here. Maybe even 75 cents. We'll see. But let's start to build our trade here. I'm going to click on this. I'm going to show you I'm going to show you this way to put this order in. So if I click on the bid price, that creates the order to get into, by default, 10 contracts. How about we just dial this down to one example contract? Trying to get, well, you know what? Let's just say 70 cents. Let's keep the math consistent with what we've been planning. So if we're able to get a 70-cent credit, how about let's change this order type to first triggers OCO so we can put in two closing orders. First order is our best case scenario. This is where we're planning to take profits. I'm going to right click on the original order and create an opposite order to close out, hopefully with a profit. This is going to be our limit order, and I'm going to set that to 14 cents. That's going to be good till canceled. So if we receive a credit of 70 cents and then we give 14 cents of it back to get out of the trade, hey, that would leave us with 56 cents of the original 70. That would be 80% of the original maximum gain. But to plan for the other side of the trade, let's right click, create an opposite order. This one is going to be to stem the bleeding on the trade. This is going to be our loss. Let's put in a stop. And in this case, this is a little bit counterintuitive. Some traders are used to putting in sell stop orders. Well, we're selling to get into this trade. So it's a buy stop order to get us out. And we're going to put that in at $1.60. Good till canceled. And that completes both sides of this trade. 70 cents to get in. Hopefully we get out for just 14 cents. If it costs us more, if we have to buy out at $1.60, that would be a 90-cent realized loss. So there's our trade. I would click confirm and send. I'll do this just so we can do our trade confirmation. I'm not actually going to send this order because I'm just standing in for Brad. I won't be here to follow up on this in future weeks. But we're selling this vertical, trying to get 70 cents for it. Then we have a limit at 14 cents. We're just saying we want to buy at that price or less to end the trade, or we have a stop at $1.60 or more. As with other types of stops, it's not a guarantee that that's exactly what we'll pay to get out. It's not exactly where the bleeding stops. It might be more than that, could be theoretically less, but just know that the $1.60 is not a guaranteed execution price. And there are commissions on both sides of these trades to get into and get out of those. All right, so at this point, we could send that off. I'm not going to do that, but it does give you a nice summary here. On one contract, that's a maximum profit of 70 cents. If we were to allow this to go all the way to expiration and just expire worthless, max loss would be $180 if the contracts were exercised and assigned, and we wound up buying the shares at 170 and selling them at 167.5, we'd lose $2.50 minus the original credit of 70 cents. That's the $180. Okay, but I'm not going to send that off. We're actually just going to leave it there. Guys, we've accomplished what I set out to do today. I wanted to talk about the trading of weekly contracts and 5 key considerations. Did I write this on there? Let's make sure that we write it. Yes, I did. There are key considerations: liquidity, time decay versus gamma risk, event risk, strike selection, the potentially enhanced importance of strike selection with the short time of the trade, and finally having a plan for profits and for losses. Guys, thanks for giving me your time and attention today. Brett will be back again next week. I think he'll be feeling better by then. Hopefully this is a short-term thing. But in any case, I do want to make you aware of additional resources available to you from Schwab Education. Lots of stuff available to you free of charge, starting with, if you are new to these webcasts, make sure that you're subscribed to our Trader Talks channel. You can go down between the video right now, just click on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube is where you can join our live streams. You can also find playlists of previous webcasts. Now, another thing that I would strongly suggest is that you follow your favorite Schwab presenters on social media. For example, you can follow me on X and on LinkedIn. So on X, you can find me at Cameron May CS. I'm very active on X, and if you reply to one of my posts here, I try to reply right back to you. And over on LinkedIn, you go to linkedin.com/in, look for /Cameron May CS. That'll take you right to my profile, and you can give me a follow there. But I post here very frequently. For example, I just posted this video a few hours ago about creating groups on Thinkorswim to organize positions within the Thinkorswim portfolio by different categories. Like maybe a trader likes to keep things organized by sector, as an example, or maybe whether the company pays a dividend or not, or they organize by strategies. Yeah, groups tend to be very popular. That's a 2-minute video to show you how to set those up. But if you reply to these posts, I just try to reply right back to you. And there's that interaction that's not available otherwise when the camera's not on. Hey, Fred, you're very welcome. Thanks definitely for giving me your time today. Scott, thanks for helping out in chat. And I have noticed that there is a survey in the chat. So if you would do me this favor, we're wrapping things up now. Click that survey link if you're one of our live attendees. And just give me some honest feedback in that survey. There's just 2 questions, and then a comments box and a suggestion box. And I'll just tell you this, if you take the time to fill out that survey, I'll take the time to read through the data. I read through the comments. That stuff gets sent right to me, and it definitely helps. It's never a wasted effort. All right, everybody, thanks. Appreciate it. Thanks for all the thumbs up. Over 100 people watching live right now, and I can see about half, 47, have already clicked the thumbs up button. That's really appreciated. It's like applause for your presenter. But it also gives my webcasts a boost in the YouTube algorithm, helps more people find these discussions so they can learn things like key considerations when trading weekly credit spreads. All right, everybody, have a great day. I will see you in tomorrow's webcast. I have something new every day of the week. As long as the markets are open, as long as I'm not on vacation, I have a new webcast. So I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.